All right, let's do some audience participation here. All right. Raise your hand if you have an insurance policy on your car. Okay, that's a lot of people. All right, I see, I love these. Everybody pays attention. Raise your hand if you have an insurance policy on your house. Okay. Raise your hand if you have an insurance policy on your Bitcoin. That's the intro. That's it. This is going to blow your mind. Okay, we've got Becca Rubenfeld and Rob Hamilton of AnchorWatch, along with Sam Callahan, to talk about insurance coming to the Bitcoin industry. Or Bitcoin coming to the insurance industry, either way you want to say it.
Hello.
Hey there.
Is this on?
Hello.
I think so.
Okay.
Mic
Think
check.
we're on.
All right.
Yeah.
So I'm Sam Callahan. You probably saw me this morning, lead analyst at Swan Bitcoin. I'm here with the co-founders of AnchorWatch, Becca Rubenfeld and Rob Hamilton. We are going to talk about all things insurance, given their expertise in that. First, we want to talk about custody. I want to do a little thought exercise here for all you guys. I want you to imagine that you have your brokerage firm. Let's say it's Charles Schwab, where you have a lot of your wealth tied up in. And I want you guys to think about it and say, I want to look at my money. I want to look at my stocks and see what my wealth's doing on my Charles Schwab app. Go on there, the app doesn't work. It's like, okay, well, let me check the website. Go on the website's not working either. All right, I'm getting a little bit worried now. Let's give him a call. Nothing. Can't reach him. A couple days go by. All right, I really can't reach anybody. I'm worried about my wealth. I'm going to go to an office. You go there, the doors are locked. Suddenly, you probably get this sinking feeling in your stomach because you realize that what do you actually own? You actually don't own anything except numbers on a screen that you can't really access. And unfortunately, this isn't a hypothetical scenario for people over the world. You've seen stories from Lebanon where they can't get their money access to the banks. And so that's the beauty of Bitcoin, because Bitcoin is a digital bearer asset that you can actually take ownership of. You can actually really take ownership of it. And that's the special things about Bitcoin. And so I wanted to turn to these people and say, what is important to you guys about custody? And why have you guys started to build a company around custody and insurance?
Yeah, so I guess to start there, for me, when I got into Bitcoin in 2013, prior to that, I was kind of like a silver gold bug. And at first, even as a tech guy, I kind of dismissed it as kind of like some internet Ponzi, something that's not related to me. But funny enough, the idea of owning Bitcoin is one of the few things you actually can have control over. And it's programmable money. Bitcoin is programmable money. And you can view that in this wide spectrum of different ways how you can manage it. But for me, what was so compelling about Bitcoin as a technology is that you can provably own something, and the entire world that runs the Bitcoin software will respect that property right. And there is no second best behind holding your own keys and being able to manage it. And there's a wide ecosystem of ways and solutions you can kind of develop custody around that, and that's part of what we're doing with at AnchorWatch.
And I think the way that you can own the Bitcoin, so when we say it's a digital bearer asset, what we're saying is you can take this piece of digital information. That piece of digital information can be moved onto a physical device, a hardware wallet. And so then you've effectively abstracted that and you've turned it into a physical item. So you can take this into your control, and now you actually have that bearer asset. So then if you think about gold, right, a bar of gold, it's very binary. You can do the same with gold. I have a bar of gold, maybe I've made that investment, I can hold it myself, or I can pay you a fee and you'll hold it for me. It's very binary. The interesting thing with Bitcoin is it doesn't have to be so binary. What I just described is a binary example. We're moving it to a hardware wallet, we're moving it offline, we're moving it away from the exchange, and I'm holding it in my own custody. Or you can split it across multiple private hardware wallets. And in that way, it doesn't have to be binary. You can get more and more secure. So to answer the question in terms of why we think custody is so important and why we're able to build a business around it, an insurance business in particular, is because ultimately you can take this asset and you can hold it incredibly securely by dispersing the risk, which is an important idea in insurance. So the custody and how it's custody is just integral to our business.
And that's kind of, given its digital nature, it allows us to do these more innovative custody schemes that might not be available to something like gold, for instance, right? Where you just kind of have to hold it in a vault. And so when you look at the fall of FTX, when you look at the fall of Silicon Valley Bank, First Republic Bank, they all have something in common, and that's counterparty risk, right? These people realized that, oh, they had my money and they were doing very risky things with it, and now I don't have access to it. When you look at custody, for an individual, it can be kind of overwhelming at first. There's a lot of, if you're a beginner to Bitcoin, it can be kind of scary, even though you understand these risks that are associated with these trusted institutions. It can be scary to take self-custody at first if you maybe aren't technical. You know, you hear stories of the guy going to the garbage at landfill because he lost his Bitcoin years ago. That always comes up every year about how it's like hard to do. But what would you recommend to a beginner to kind of get started with custody?
It's so much easier than it was 10 years ago. When I got into Bitcoin, I had a paper wallet, and if you've ever seen the movie Office Space, where they take the printer with a bat afterwards, that's what I had to do to like make sure my stuff was safe. And now, as Becca mentioned, you have things like a hardware wallet. So the cold card, the stickers you've seen, they look like little calculators. They're really powerful devices that allow you to keep your Bitcoin safe and secure. So my initial advice would be, one of our buddies, American Huddle, talks about this. It's kind of like learning how to drive. You don't go immediately onto the highway. So maybe what you want to start with is just taking a couple, like $100, put it on your phone. Get familiar with it, making your backups, feeling comfortable with it. And then as you're increasing your wealth, moving over to a hardware wallet and making sure your backups are secure. And one of the most beautiful things you can ever do with Bitcoin to prove that you and only you own it is you can set up your Bitcoin, you can make your backup, and you can delete the wallet. And then you can restore it on another computer or another device, like a hardware wallet, and see the money there, right? You can delete and move it around, and it's something that people say you can keep it in your head, and it's a really powerful concept, and that's how I would kind of encourage people as they're starting their self-custody journey is start with a little bit, get comfortable, get a hardware wallet, and practice makes perfect.
What Rob is describing is true self-custody. So that's, again, back to the binary. I'm taking control of the Bitcoin. I'm taking ultimate responsibility into my own hands. There's also a middle ground that we offer, other companies here offer, called supported custody or collaborative custody. That's this idea, I alluded to it before, where you can split the Bitcoin into multiple hardware wallets and disperse those against multiple parties. So maybe you could hold keys as the owner of the Bitcoin, and then you could have an institution hold keys as well. It's less risky than having a single institution hold all the Bitcoin for you. So you could say, I trust FTX. Well, we know how that goes down. So what collaborative custody does is it gives you the ability to have a backup. And so what AnchorWatch does is a version of that where the customer holds keys, but also AnchorWatch holds keys, and we both have to work together to sign a transaction. And so we're able to give kind of peace of mind, backup plans, kind of catastrophe planning, and then because it's ultimately so safe, we add insurance on it as well.
Yeah, we'll certainly get into that insurance. I think of collaborative custody. I love those movies with the vaults where you have two people with two keys at the same time who have to go in. That's kind of what that is. It's just kind of these safeguards in place. If one person loses one key, you can kind of have a partner in it that kind of helps you protect access to your funds.
Yep.
And that's what Unchained does. That's what kind of you guys are helping build over at AnchorWatch. And that's kind of what institutions need, right? Like an individual has these options. You can have one wallet, you can have collaborative custody, but these institutional investors and institutions, they kind of need different custody solutions.
Yeah, and it goes back to this concept of aggregating risk, right? If one person, one entity is holding all of the keys, you've concentrated your risk in one location. It's called a single point of failure, and you don't want that with your money. We had that with FTX. Sam Bankman-Fried was the single point of failure, right? He had the keys. He was able to move the money around with no oversight, no governance, no compliance. But institutions, and this idea of distributing keys is perfect for more complex business arrangements. For example, like with Build Asset Management for the collateral they're doing for these Bitcoin-backed loans, those are in multi-sigs. They're not all sitting in one person's key. So you get to have this observability and governance to make sure that the collateral is secure. And as programmable money, at a moment's notice, it's a liquid market. You can sell that and cover your loans, right? And so as you get into more involved financial contracts, you can lean on this aspect of Bitcoin being programmable money to be able to do risk distribution for insurance, to be able to do more advanced collateralization for loans like Andrew was talking about earlier with battery. There's a wide open opportunity of ways that you can kind of leverage Bitcoin and bring it to the financial system. I think a lot of people in Bitcoin think the institutions are coming and they're sitting in their bunker with tinfoil wrapped around their head with their Bitcoin. But really what it is, you know, I'm sitting here with a suit today because it's a lot of, you know, bringing and designing products that the financial markets will be able to interface and understand in a way that it's a better asset than what they currently have available to them.
I think it's a very familiar idea for business owners. So if you're a traditional business owner, you need to spend money. Maybe you're writing a large check for a purchase, an acquisition, capital expense. You have most likely spending procedures in place. So maybe above a transaction a certain size, maybe multiple officers need to sign off on the transaction. So you have corporate governance and compliance in place, and that's actually a very familiar process. So when we talk about multi-sig, when we talk about where the customer has to hold keys, maybe AnchorWatch has to hold keys, what we're doing is we're taking traditional corporate governance and compliance and we're encoding it on the Bitcoin blockchain. So we're taking those rules of spending and we're just putting them on the blockchain itself, and that makes them immutable, right? We cannot change those. Once the rules have been set, even AnchorWatch, even one of these other companies that provides a service, they can't change the rules. So it really is just taking a very typical or a familiar idea of authorizations and checks and balances to spend money, and it's bringing it to Bitcoin.
So you say Bitcoin's programmable money and you're encoding those rules into the immutable blockchain, all right?
That's right.
Does that like reduce fraud, or how does that improve the processes by making it programmable?
It absolutely can. It absolutely can. So in terms of, say, reducing fraud as an example, let's say the rules of a Bitcoin vault are, you know, that these specific 2 keys must sign. Mm-hmm. So that's been programmed. One of those individuals could not successfully, say, steal from their own company without the other. So really just by taking, again, these checks and balances that we all kind of interact with in the traditional world, and it's adding this physical aspect of saying like, no, you literally can't do it without, you know, his help. So then if we take that idea, you know, the business that, you know, the hypothetical business is getting bigger and bigger. We're talking about really large sums of money. You know, maybe we encode the vault, the rules, to say these 5 keys must sign, you know. And so then you can really, again, just think about it in a very traditional way. You can think about, all right, so the 3 officers are gonna have keys, you know, the CFO, the CLO, the CEO, maybe a board of director, they're going to have a key, and maybe an external auditor is going to have a key. And ultimately, so once you start encoding that on chain, it becomes a unbreakable rule that must be followed. And then in terms of fraud, ourselves as insurers looking at the chances of fraud, every time we add an individual to the group of keys, the chance of internal collusion is going down significantly every time. So maybe the chance of, you know, 2 people who've been in business together their whole lives, like maybe the chance of the 2 of them colluding together, it's more than 0, right? You add a 3rd person, the chance of 3 people colluding together actually goes down actuarially. You add a 4th person, drops way down. You add a 5th person, it just becomes a very, very tiny risk. So to be able to take that premise and again, encode it on chain is very powerful.
Anything to add, Rob?
Well, just to even add to that, you know, when we're talking about this idea of like multiple signers, like Becca was going through, like within a company, we could also have it set up so that a 3rd party is required to sign to move the money, right? And this is a concept forces everything to move slower. You can't overnight have all the employees sign and rush and run off with the money. You could have it be like, well, you have to do your signatures, and then a third party has to step in, and they may have a SLA of 24, 48 hours, and at that point you're sending emails out, you're letting everyone know, hey, you're looking to move some money, and if you're trying to do a coordinated heist like that, or what we often call in Bitcoin, a $5 wrench attack, which is someone shows up to your house with your $5 wrench and says, give me your Bitcoin, time is the enemy of all of these kind of nefarious activities. So by intentionally going slow to go the right way is a way that you can, just by even having this technology in place, mitigates risk. Because if you're trying to find the easiest way to pull a heist off, you're going to go after someone who has lower quality governance of their money. That's why oftentimes people leave their money at an exchange. That is such an easy spot to pull off a heist. You do a SIM swap, you take and hack someone's phone, and money's gone. And there's no refunds, right? Doing this more encoded, involved governance for larger institutional sums of money allows you to kind of encode these more elaborate financial contracts on chain, and also just actively disincentivizes all of the low-hanging crimes of opportunity, you may want to call it.
Let me give you another example. So I gave you an example of internal collusion, internal fraud. Let's just say you're an individual, you own Bitcoin. That taking self-custody, sole custody, that's a lot of pressure. So you bring in, you want to work with a company, that has experience holding keys. Now, I've talked to 2 people in casual conversation just here today who lost money at FTX. I bet there's more than 2. So the idea was that, all right, well, this is a big company, right? I can trust them just because they're big. I should be able to trust them to hold the keys. When you bring these multi-sig in and you encode it on chain, in this example where the customer has keys that must sign, what you can do is say, all right, I'm going to bring in a company to help, but I'm not going to give them full power. So I'm going to bring in a company to help in case something goes wrong, to kind of split the responsibility with me. But there cannot be a transaction unless I, the owner of the Bitcoin, also sign off on the transaction. And so now, using this technology, we can mitigate external fraud as well. So now we can get some outside help, we can get the benefits of having a fiduciary or some sort of helper, institutional helper, without the risks of it.
I mean, it makes a lot of sense to me. I mean, you're basically taking human processes out of that and you're encoding it in the blockchain and putting rules and restrictions in place so that you maintain control over your money, but you have some help if you need it. So there's those safeguards. Talking about insurance, people in the traditional financial world, they've gotten comfortable with the idea of, say, having FDIC insurance with some of their funds. Now, despite the fact that it's completely underfunded, it has like $120 billion for $17 trillion deposits right now, but they're used to it. It makes them feel safe. Right now, what's the Bitcoin insurance industry look like? How is it evolving, or how do you guys see it evolving over the next few years?
So I think just to start, insurance fundamentally is an uphill battle when it intersects with Bitcoin. And that's because insurance is a state-level regulated entity. It's actually an artifact of the New Deal with FDR. It was the one thing that Congress said, no, you can't federalize this, we're keeping this to the states. So there are 50 insurance commissioners for every single state in the country. And they come together as a governing board called the NAIC, National Association of Insurance Commissioners. And they've classified Bitcoin as a non-emitted asset, which means that if you were to buy Bitcoin as your insurance company, the health of your insurance company is how large is your capital surplus. If you were to put $100 into Bitcoin, you have to take a $100 write-off on your capital position as an insurance company. Now, there's an interesting dynamic that comes to play here because in December of 2020, MassMutual bought $100 million of Bitcoin. The price at the time was $20,000. They have a $1 trillion balance sheet, and $300 billion of that are whole life policies. And where are they parking their money right now? Treasury bonds. They're willing to take that $100 million write-off today, and they've already seen a 150% increase because the Bitcoin's liquid. They can sell it at a moment's notice and recognize it again on their balance sheet, and they have a large enough balance sheet to do that. So just to talk about how the insurance industry at whole views Bitcoin as a capital side of the balance sheet, that's kind of like the perspective. It is an uphill battle that we're making progress on.
Now, in terms of, say, individuals or companies' ability to get insurance on their Bitcoin, It's been a huge problem. It's been a underserviced area, and that's what we're working to provide that service and fill that gap. So we know that Bitcoin today is $500 billion, a little bit north of there in terms of market cap. In total, globally, there's a few $billion of insurance capacity on the market, out on the marketplace, meaning the capital markets in total have put a few $1 billion towards this asset class. Why is that? Why is it so low relative to this asset class? Because the technology, the security, is developing quickly. A few years ago, Rob is talking about using a paper wallet, right? What that means is like the entire security was literally written on a piece of paper. So over the years, the security, the ability to store this bearer asset, that if you lose it, it's gone, has gone from, quite risky, quite risky when you think about a piece of paper, to more and more secure until the point that we're at now, that we're describing something that we're saying it's actually easier and more secure to store Bitcoin because of its ability to be dispersed than a bar of gold. It's easier and safer, whereas 7 and 10 years ago, it was so much more tenuous. So the insurance industry is not the fastest, right? So it tends to be a lagging industry. It's very risk focused. It's very much looking at the downside. And so we are working very hard to bring them along on their understanding of the realities of the asset class, which is to say it's actually extremely conducive to being stored securely. And we're working to bring a lot more capacity to the industry.
And just to quickly add, they are savvy capital allocators. They understand. We've had conversations with a lot of them in the past months, and a lot of opportunities come to market where they'll use this thing called MPC, which are these internet-connected computers that are like securing Bitcoin, Ethereum, Dogecoin, like the whole mess. And the problem is that's internet connected, and it becomes cyber insurance. And it's just they can smell that immediately and be like, this is not. You're trying to compare this to a bar of gold. This is not a bar of gold. A bar of gold is not connected to the internet, where if you download a virus, the money's gone, right? So part of our approach around this is using air-gapped machines, hardware wallets, in a way where we can say, no, if this is more safe than that bar of gold. And I think that's part of the education that we're bringing to them so they can better understand that this is a very insurable asset.
So you guys have been speaking to major insurers out there.
The most major.
Yeah, the most major insurers.
That's right.
You've been actually getting your foot in the door and having conversations. What have they been like? Like, have they been pretty receptive to the idea of Bitcoin?
So I'll say yes, but it's been a long road. So we've been building these relationships for 12 to 16 months, and the conversation started not unlike the conversation started this morning. I mean, I remember having a first conversation with a major reinsurer and starting out like, so money is an idea, right? And like really starting at the very, very beginning. And so over really, months and months of building up that knowledge to get them to the point that they understand how they're allocating capital. And the shortest answer is we expect to be selling policies in January. So
wow,
definitely, thank you. So it definitely has been receptive, but it's been a labor of love and a labor of capitalism, and explaining to them why, again, it goes back to the security of the custody. The reinsurers, so the capital allocators who underwrite us and our program, and ultimately the Bitcoin itself, they're capital allocators, and they're looking to make sure that if they lock up their funds to underwrite this program, that the losses that they incur will be at or below what has been forecasted. And so that's the calculus they're making. They're like, all right, Rob and Becca, you're telling us, that we can expect this sort of behavior, that we can expect this sort of security. do we agree with your assessment, with your claims? And we've gotten to the point that we've built that level of understanding. We've been able to show them, effectively proof that is not AnchorWatch. It's the proof of Bitcoin. It's cryptography, and really had to take them through every rabbit hole that we all go through, that we all go down and learn to build that confidence. And I think we've had great success.
Yeah, and just to add, they pay attention to the market. So if you were paying attention to the FTX trial 2 weeks ago, one of their senior engineers came in and testified. They had on the FTX page the FTX Insurance Fund, which was a random number they did some multiplication on and just put on the page. It was a total fraud, right? And insurance, we often look at it, and I think it's like probably the second most regulated industry behind banking itself. And it means a lot that, to actually have insurance, it has a specific legal definition. And it's not something you can just be like, assurance versus insurance, right? That's kind of like the linguistic game we may want to play between hedging the line. What we decided to do when we started AnchorWatch was tackle that hard problem of actually aligning capital markets, being able to provide a regulated, safe, secure product, because ultimately, if you're willing to make that allocation to Bitcoin, you've already accepted the premise there's price volatility, right? That's part of the narrative, it's part of the fun, it's part of the story we talk about at Bitcoin, and over a long enough time frame, you come out well far ahead in risk-adjusted returns. What is not acceptable, though, is a key man risk. The idea that one rogue employee or two, you can have people can certain act against you and you get nothing if it all goes wrong. Celsius, FTX, BlockFi, now Prime Trust, Fortress Trust, all of these companies, that regulated trust companies, they're now just shown to have massive, massive holes in their balance sheets or be outright frauds in some cases. And the idea is this industry, this is, I think, an important distinction Parker made earlier today. We're focused on Bitcoin. I think a lot of these shell games were happening because of the larger cryptocurrency industry, and there was a lot of fast and loose money not paying attention. But this is what people want. If you actually want to be able to, if you're paying for custody, and this is I got a preview of, Becca wrote an article for our blog series that's coming out, Custody Without Coverage, and ultimately, if you're going to have a custodian, if something goes wrong, you're looking to actually get indemnified, and the idea of paying a SaaS fee versus an insurance premium, it's not actually risk aligned to the incentives for the customers at the end of the day. They want to know if they're putting their Bitcoin with you or across other entities, that if something goes wrong, you're going to get paid out. Because otherwise, what are you paying for? Right? That's the entire reason why if you're going to, in a corporate structure, give someone else access to that money, you want to know that if something goes wrong, you will be paid out at the end of the day.
Yeah, and in terms just, one more thing just about the state of the industry and how we chose to approach the capital markets is we decided as a strategy to absolutely go after the very top tier of insurers. So, many people here relatively new to Bitcoin, maybe whether they're in traditional finance, business owners, and they're certainly familiar with insurance as a vehicle. They're less familiar with holding Bitcoin, and we want the existence of insurance to give a lot of confidence. That's part of our goal as a company, is to say you should have confidence holding this asset because it has extremely high quality insurance on it, and that insurance is very familiar. This is property insurance. This isn't crypto protocol insurance. This is a product that you're very, very familiar with. It's very similar to the coverage that's on your home, for example. And so we chose to go to the absolute top of the pyramid in terms of the quality of those insurers. So, you may be familiar that insurers are rated. So there's A minus, B-rated insurers. And so we are very, very committed that when we start selling, it's going to be an A-rated carrier. And we think that's extremely important. And, as a new industry, which this ultimately is, that is part of the reason that the due diligence period, was very intensive, because we wanted the best quality right from the beginning.
Yeah, and institutions, they want to see that market credibility with a familiar name, with a very long track record,
Absolutely.
Respected insurer, right?
Absolutely. What we heard is they either want to see A-rated or Lloyd's of London, or both. And
Wow.
that's what our insurance will be.
Yeah, So, and then these institutions, so people have said that institutions are coming to Bitcoin for a long time. I think simply Bitcoin wasn't a large enough asset for a long time, but it passed the $1 trillion market cap during the last bull market. It's at about 600 million. It's finally kind of maturing. But in terms of institutions, they need some of these products. They need insurance and they need other ones. What are some of the other developments, Rob, that you've seen that are maybe bullish for institutions getting into Bitcoin?
I think for general institutional adoption, there was the FASB ruling, the Financial Accounting Standards Bureau, that just came out with their guidance. So prior, when Michael Saylor was buying all of his Bitcoin, it was counted as an intangible asset on their balance sheet, which meant you had to basically honor it at the bottom tick of price. And that was, you couldn't market higher than that. So if he bought Bitcoin at 20,000 and it went down to 15 and then up to 60, he had to market at 15 on his balance sheet. Now this, in the past year, has actually just been updated. And it's funny, because again, Bitcoin is the most liquid market in the world. 24/7, 365, you can find a buyer and a seller, and you can execute a trade whenever. This is materially different from stocks and commodities and any other financial asset out there. And the fact that you were basically penalized for using something a little bit different, that's been remedied now. So now companies can actually get their Bitcoin exposure and actually honor it on a mark-to-market basis, which out of any asset, it is the most likelihood. There are no circuit breakers in Bitcoin. If the price goes down 10% in a day, there is no one that turns off all of the stocks, all of the brokers, and says, let's cool off for a couple hours. Like, it is the most fair asset to be actually pricing on a mark-to-market basis. And I think that's a massive unlock for being able to get people that actually can recognize it in a sensible way on their balance sheet, recognizing GAAP accounting rules.
Yeah, I mean, I think there are rulings like that, so how it's treated. I think some of the custody solutions that we started our discussion with are vital, getting to the point that an institution can say, all right, now the technology is such, the security is such that we feel confident in the actual custody. I think that's really important. I think mature, financial products. We heard from Andrew and Battery earlier today about the melding of Bitcoin with other asset classes in really novel and interesting ways that allow institutions to make investments in ways that they hadn't been able to before. And then I think our insurance is really important. So I think all of those things together are going to make these next several years very, very important for institutional adoption.
Well, very, very interesting, too, for Bitcoin. I mean, we talk about the scarcity, and I know at Swan we talked a lot with family offices, RIAs, pension plans. Everyone's kind of getting excited about this thing, but they need tools like what AnchorWatch is building. And so we're out of time, but is there any last kind of comments that you guys want to say to the audience about this?
I mean, no real comments. I've loved being here today. I think hearing everybody's curiosity and interest in different expertise areas has been great.
Yeah, and just like Missouri was, kind of the intersection of the country, right? That smack dab in the middle. That's what we're doing here today. We're coming from the Bitcoin side, packaging and bringing this in a way so the institutions can meet us in the middle. And I think that's the best way to do financialization, whether it's what we're doing at AnchorWatch, what Andrew's doing at Battery, what Unchained's doing with loans, with the build team of facilitating that. This is the actual institutional adoption, is bringing and cultivating the products from our side on Bitcoin and bundling it in a way so that traditional finance can have access to it, understand with it, and make it part of their toolkit ultimately at the end of the day. And that's where we get to really see the magic and synergy.
Well, thank you very much for sharing your guys' thoughts.
Thank you to Rob, Becca, and Sam.